Welcome back. This is episode 189. In this week's episode, I have a special guest, Brie Williams with State Street Global Advisors. Welcome back, Brie.
Thank you for having me again. It's nice to be asked back and to talk to your listeners and you once more.
Yeah, I think we did a good job last time. We talked about some of the challenges for women investing. And this week, I want to talk about investor biases, what they are, how you can, recognize them, do your best to try to overcome them, and then if we still have time, talk about how a financial advisor can really help you to overcome some of these that could really be an enemy to your investing success.
Sounds good.
So, just for those that missed our last episode, just tell me a little bit about what you do with State Street Global Advisors.
Sure. So, State Street Global Advisors is the asset management arm of State Street Corporation. And interestingly enough, next month in March marks my 10-year anniversary with the firm.
Oh,
So
congratulations.
thank you. It's a nice milestone. I do lead our strategic consulting solution group, and we support financial advisors just like Ryan for the U.S. and even around the globe. And many of the listeners, I'm sure, know about, if not use, our Spider ETFs, which is the products that we provide investors with to help them achieve their financial goals and investment plans that you're guiding them with. I think when you talk about like what does my team do, because it sounds very vague when you say, well, it's consulting and solutions to help businesses grow. It's pretty
Sure.
macro. I think we do play a unique role in the space. The team that I lead, they're called practice management consultants, and they work hand in hand with financial advisors to help them in their leadership skills as well as talent development in terms of people that make up the advisory team that are supporting them, what's to run the business more efficiently, so some operating leverage, also the ability to think about engaging clients, the individual investor, just like you on
Sure.
the line
Yeah.
listening. So the ultimate goal is what we share is how can we help the individual investor have not only an enjoyable financial journey, but one that's going to be prosperous and in line with what they envision as success.
Of course, yeah. I mean, I've been using State Street funds for my client portfolios for a while. That's how we got connected. And
Yeah.
State Street was the original ETF, right, with
Yes.
SPY.
Yes.
And since then they've come out with a lot of great additions for other areas of the market. So as a financial advisor, I've been doing this for since 2001, so almost 20, well, my 23rd year, I
Mhm.
guess. I can tell you money, from my opinion, is definitely emotional, right?
Yeah.
They always say don't get emotional about your money, but that's very hard to do, right? Especially when I'm dealing with most people planning for retirement. If they lost all their money, they'd get pretty emotional, right? I
Yeah.
mean, their retirement would be in jeopardy. So what do you feel like, what does emotion role does it play like in decision making and maybe like how would that impact somebody's decisions?
So I think it's all important for everyone to remember we are human beings. It's not about being perfect, but it's constant improvement to have a financial life that we can be proud of and continuously learning. So when you think about the role of emotion, you hit the nail on the head. It's extremely powerful, and it does drive our behavior. So we have to think about how do you channel emotion properly because it can be a force for action. So no one should think that emotion and money don't mix. They actually can coexist productively when you have greater self awareness of the role that emotion plays when we make decisions, how you approach that process. And I think that this conversation that you're putting forward, is going to be very helpful. When what's a good recent example of where I think we saw emotion, all of us experiencing it, not only in ourselves but watching it with our neighbors in our communities was 2020. Clearly, that's when we were challenged navigating an entirely different space for all of us with the
Sure.
global health pandemic
Yeah.
that shook financial markets as well as our own lives. So we approached investing a little bit differently during that period because we had heightened volatility, prolonged uncertainty, and it was a completely new normal, and it changed everything for us, not just our investing life, but like we were working from home, we were doing school from home, we weren't
Sure. Yeah.
going anywhere in the early stages of that. So it's difficult when there's change, and that was a lot of change all at once on top of having high uncertainty. And so uncertainty unto itself, leaves us uneasy. And it probably is one of the things that we like to deal with the least. If you let uncertainty just kind of sit out there, you can easily just, think about the last time you were uncertain. And if it lasted for a little while, start to get anxious. And that's a normal reaction,
Yeah.
absolutely normal. So, I do want to say that uncertainty is not always bad, because I certainly haven't run into anyone that runs around with a crystal ball, and knows
Yeah.
exactly what's going to happen next in every way. But you do need to think about how you can manage behavior and emotion together with logic, so you have a balance, a framework, if you will, that's healthy for you on how you approach your financial life, and ultimately bringing that to the table with your financial advisor on how you make decisions. So I think these money talks that you host, Ryan, are really productive. And if people engage in these conversations and get comfortable talking about money when it's stressful and when it's not stressful, then it's an incredibly powerful tool that you have as an individual investor, as a family, and with their financial advisory partner, to give those emotional appraisal strategies a real chance to
Yeah. I
succeed.
mean, for sure, you talk about uncertainty, right? There's nothing more uncertain than investing in the stock
Right.
market in the short term, right? I mean, studies, data shows over the long term, it's generally a great investment, but in the short term, that's anybody's guess.
Mhm.
And so, how can one's attitude or mindset kind of influence their behavior, as an investor?
So, social psychologists have found that one's attitude and the actual behavior, it's not always a perfect alignment. They do play roles, though, obviously, in the way we approach decisions and how we gather information and what we do with that insight that we've consumed. So, we all have the ability to learn from what we do. And when you think about your attitude, yes, it's enduring, but it's something you can change when you approach decision making a little bit more purposeful. You learn from how you approach the logic and the emotion in a decision you were making last time. So you're almost being a student of the business
Sure.
in your own behavior. And when you have a partner like a financial advisor, she can help you be more objective and, kind of just dissecting, well, this is what we decided to do last time. How did you feel about that? Maybe we want to approach it this way next time. Or a reminder, if it feels like you need to make a choice right now, do you really need to? Is it that time sensitive? Can you take a breath? Do you need additional information for context? So that's why we say, attitudes and mindsets play a role, but know that it is something you can change with purposeful practice. That brings us really to the life orientation. That's one's view on how you think about things in the world. And there's really two schools of thought when you consider that. That's optimism and pessimism. And where one falls on that spectrum is a fundamental human trait, and it's reflective of our own cognitive biases. When I think about reality, most of us are going to fall. I don't really know why the thumbs up goes on my screen.
Thumbs up. Who was that? I didn't even know there was thumbs up on this
Yes,
recording
yes, that was
possibility.
me
So, okay.
listening. I am not controlling that. But anyway,
Let me
back
see something
back
here.
to, so obviously you agree with
Yeah.
what I'm saying for giving me the thumbs up here, Ryan.
I did not do that, but maybe in my mind I was doing that.
Perhaps. But when you think about optimism, pessimism, I don't want anyone, stepping back going, ooh, it's better to be on one side of the spectrum versus another.
Sure.
Most of us are going to fall somewhat in the middle. And where you do fall, it doesn't mean that's where you always will be. So you can work on behaviors and practices to be more in the positive direction if you are tending to lean more in the pessimistic camp. We do have a short assessment if someone's curious as to where they fall on that spectrum.
Okay.
We can
Yeah.
make that available to you and your listeners.
Yeah, I'll put a link in that to the show
Okay,
notes. Yeah.
fantastic. It's the very same one that's used in psychology today. And so it gives you some context. It's worth just getting a handle on where are you today. I know when I did this with my husband, he assumed I would be a Debbie Downer. Taking
Okay.
into account, I guess, how our conversations go. I'm a realist. And I was actually more positive than he was, which was a bit of an eye opening
Oh, interesting.
experience. And then my
Yeah.
being more aware of what his natural tendencies are and how he views things, and him the same with me, that actually improves our own conversations around finance. Just because we have a better appreciation for where each other is coming from naturally in terms of those
Sure.
tendencies. What I would also say is, it's not an either or in terms of bad and good. Just like being an introvert versus an extrovert, it's neither bad or good. It's really about not taking to either to the extreme. So you want to find that
Yeah.
balance, and then also knowing where you naturally are inclined to view things, meaning the glass half full or glass half empty. Then with that self awareness, you already are empowered to understand. Well, I assume the other shoe's going to drop. So knowing that, you can
Sure.
counteract that a little bit more in terms of how you take in the information.
Yeah. I mean, if the stock market or your investments are doing well, you can't really assume they're going to grow every year like that, right? Straight up. It doesn't happen that way. Or the opposite, too, right? When
Mhm.
things are going bad, some people extrapolate, oh, it's going to keep going and I'm going to go to zero.
Right.
It's somewhere in between.
Right.
So, we talked about, or I mentioned in the beginning, we want to talk about investor biases.
Mhm.
So, what are, for my limited research knowledge, there seem to be a lot of these out there. Like maybe you can hit on some of the most common ones that people might be dealing with.
There are a lot. You're absolutely right on that. Psychologists have identified at least a dozen. And if you were to just Google biases in general, you could even find up to
Sure.
over 175. So very,
Oh wow.
very
Okay.
deep
Yeah.
list. But I think this is more about kind of uh, not boiling the ocean. How can we focus in on some that are the most common that impact
Sure.
financial decision making when we consider our investor behavior? There's really two ways to group the types of behavior. There's cognitive, and then there's emotional. Let's just focus on cognitive for a second, and let me define that
Sure.
so we're all on the same page. So cognitive errors really stem from things that are basic statistical information processing and or memory errors, and that simply means it's faulty reasoning, mental shortcuts. And
Okay.
we do this every day as we are
Yeah.
making millions of decisions all day long. So your brain is just trying to help you get through by taking those mental shortcuts, and sometimes that is not going to lead to a positive outcome because you have these natural biases. So there's even two further subcategories within cognitive errors. There's belief perseverance. What's an example of that? Conservatism, confirmation, representativeness, illusion of control, hindsight. And then there's information processing biases. That would be things like anchoring, adjustment, mental accounting, framing, and even availability bias. We could probably spend hours going through all of this. If I just, what are the top three in cognitive? Hindsight
Sure.
bias, confirmation bias, anchoring bias. What's hindsight bias? That's an investor's tendency to believe that after an event has occurred, I predicted it. I knew that all along that was going
Sure.
to happen. Um,
You knew the stock market was going to crash, right?
exactly. Great example.
That's why I got out.
Yes, perfect example. Whereas confirmation bias is are a tendency for an investor to seek out information that confirms what an existing
Sure.
belief that you have is, even ignoring contradictory information. And you could see yourself doing that where you focus in on news articles or analysis that
Yeah, like
supports
you only read the same
why you
political
buy it.
spin or bend, right? Or if you love a stock, all you do is just focus on the good
That's
articles
correct.
about that stock, right?
That's correct.
So,
And that leaves you ignoring the potential warning signs because you're not getting the other side of the story. or not willing to even take it in in that regard.
Yeah.
And
Yeah.
then anchoring, which I think is a really interesting bias, is when you rely too heavily as an investor on an initial piece of information that becomes your anchor when you make a decision in the
Sure.
future. So I think a great example there is, what price did you buy that stock at? And then when
Yeah.
you're deciding, do I buy it? Do I hold it? Do I sell it? You're going to be anchored in whatever you paid for that price, and that's where you hold the value.
Yeah. That could be like holding your losers too long, meaning that you buy a stock, doesn't work out, but you keep holding it like, oh, I just want to get back to what I paid for it. But then you might
Exactly.
ride it a lot further down, have a lot more losses because you're not looking at the other information that's out there.
Yes. So then going to the emotional biases side, the other half of the dozen or so biases that we're trying to focus in on here, that's really stemming from an impulse or an intuition that an investor will have. And that tends to result in reasoning that's influenced by your feelings. Examples here would be loss aversion, overconfidence, self control, status quo, endowment, or even regret aversion. I think the two
Sure.
most common emotional biases that we see frequently flexing their muscles with investors is loss aversion and overconfidence. What's loss aversion? Loss aversion is a tendency for an individual investor to feel the pain of a loss much more intensely than the pleasure of those gains. Even behavioral economics have put science behind that, so it's not just theory. And there you pulling on an example you pulled out, you're holding on to that stock too long because you're hoping it's going to rebound. When it's
Sure.
clear selling it would be the rational choice to minimize further losses. Um,
Or the opposite, right? Like loss aversion, because you went through, as we all have, you've been investing for 20 years, recent market correction, go back to COVID, right? Markets were down 30, 35%. As soon as you see the markets go down 10%, you bail on your portfolio because you don't want to see it go down 20. But then what if 6 months later things have turned around that it's actually gone up, right? I mean, that's loss aversion and it's cost you long-term returns, gains
yes.
potentially.
And those pain points we remember much more vividly. So they
Yeah.
tend to stick around for a while. So even we're still talking about how 2020 felt. It was a very volatile year, a lot of uncertainty, and depending on what types of choices you made, there may definitely be loss aversion in your decision making mix as a influential factor, bias that you brought into the process. We also saw,
Especially if you went through, 2000 to 2002 where
yeah.
you saw those losses and you're thinking, well, I'm never going through that again. So,
Yes,
but yeah.
yes.
Yeah.
But then, the opposite of that would be overconfidence. So that's a bias where the investor has an inflated belief in their own ability to predict a market movement or even pick winning investments. So if that's the case and you're suffering from overconfidence, you're likely overconfident in the fact that the research you've done on that particular company, is excellent, and it's only going to continue to rise in value based on what you've pulled together. And what you're doing instead, because of that overconfidence, is you're ignoring some of the potential downside risks, things you can't control, such as a change in a market condition or another unexpected event, which could result in a loss on that stock if it doesn't perform based on that external factor or factors.
Yeah. I mean, this could be somebody that maybe only has their portfolio concentrated in a few stocks, right? You could do really well with that,
Mm-hmm.
but you could also do very poorly
Mm-hmm.
if you know, don't ever change your belief on what you own.
Yeah, I mean, again, I think what's important for investors to realize is that we all have bias, unconscious and conscious, and it's how do we gain greater self awareness so we can regularly reflect on the way we've approached past decisions with our investments and what the outcomes were based on what we brought to the decision making table. And what I'm not saying is this is not about regret, nor is this about second guessing. This is the opportunity to uncover, hey, what was my blind spot? Or take
Sure.
time to objectively recognize a pattern that you have in some of your decision making. And I think it's easier to do when you can sit side by side with a trusted advisor, because she's going to pick up on those things before you do, because they
Sure.
have a
Yeah.
more objective seat in that case. But be willing to hear it, listen, ask about it. Because again, those productive conversations to kind of just dissect how you arrived at these choices and what the outcomes were, good, neutral, or negative, you can continue to improve and gain more self awareness of where those tendencies lie, which biases are louder for you, and work on
Sure.
strengthening those so you can improve over time, become more prudent as an investor. And so I think two strategies that people can start working on immediately is you do have to be willing to acknowledge that there is a bias, or it could be more than one bias
Yeah.
work at the same time. And that's by getting that awareness of where your mindset is, know your natural orientation, be comfortable identifying some of your weaker spots and be willing to work on them, and ground yourself in meaningful focal points. Your purpose for investing is a great one, which is usually both short and medium goals, in the more immediate decision making time frame. But then also don't lose sight of what ultimately are you striving for, those retirement goals that you're helping them really hone and do you want that bass boat, do you want that second house, is the goal to retire a couple years earlier than you initially had planned, is it to allow someone to drop back from income production in their job today to do more passion project earlier. There's lots of levers that you can start pulling
Sure.
that I think are really productive anchors to focus on when you think about bias management. And then the other one that's an easy one to do is, very rarely do you have to make a choice that second when it comes to your investment
Yeah.
decisions. So delay, get the additional information that you need, talk it through with your advisor, have a more expansive mindset so that objectivity comes into play, and you can bring both the EQ, the emotional quotient, and the IQ, your logic, to the table equally.
Yeah, definitely. I mean, I've been doing this, as I said, as a while, so I've been through a lot of different markets, and I've talked a lot of clients off the ledge in the sense that they were ready to sell their portfolios, especially during COVID.
Right.
I mean, we didn't know in hindsight, right? We didn't know what was going to happen. We didn't know if like this was the zombie apocalypse and
Mm-hmm.
we were never going to emerge from our homes ever again unless we were in hazmat suits, and it was scary, right?
Very.
And but for a lot of people that I work with, like you said, they're investing for a reason, for retirement, right? To either get to retirement or in retirement, they're living off their money. So that didn't change. And trying to help remind them of that, but also looking at the worst case scenario and also the best case scenario, right? The people that held in there and didn't get out of the markets, they were rewarded. Now, that's not always going to happen, and it happened very quickly, too. I mean, it was a V-shaped recovery.
Mm-hmm.
But I think, like you mentioned, having a trusted advisor, someone you can talk with, taking a breath. A lot of times when things get bad, people feel like they have to do something.
Right.
I've got to make a change, right?
Right. Well, that's based on an emotion itself, which is fear. And fear can be expressed as a loss of control. So how you counteract that is by taking control back by doing something, anything.
True, right? Yeah.
But again, the ability just to kind of talk it through doesn't mean you won't take some action, but it's, where is the point of I can sleep at night and not derail the plan to take the
Sure.
action that makes me feel like I've got a little bit of control back. And that's, understanding your plan's built to be resilient in the up and downside portions of market activity.
Yeah, and I stress all the time, like for my clients and listeners, that having an asset allocation, right, as a starting framework is very important. And then also knowing with that, like what's the best and worst case scenario. Because if you have some of that in advance, then you at least have in your mind, okay, this is, even though this can get me to my goal, like in the process, here's the worst case scenario that could happen before I get to my goal, so that you don't bail on your goal before you get there. Don't give it time.
Right. Yeah, well, it's hard to keep that front and center because those are just farther away, and the noise that we all are listening to, financial news, whether you're watching on television, listening on satellite radio, your podcast, your neighbors, your colleagues at work, your family, you have to realize that it's probably only about a dime size amount that's really relative to what your plan is about, what you're striving to do, and your personal goals and objectives. So you have to learn to turn that volume down and consume less, or consume more objective information along with what you're naturally inclined to want to see to confirm that
Sure.
bias of what you believe to be true, but not losing sight of the primary purpose. Is It can be a very helpful technique in terms of calming down when it feels like stressy times are here.
Yeah, I mean, so if we focus like on one of the earlier examples, like anchor bias, right?
Hmm.
Um, what is like how could somebody try to overcome that, or what could they do to help them better deal with that?
Sure. So just to bring that definition back around, this is an information processing cognitive shortcut. It's also a really challenging one to mediate. The anchors that initial piece of information that influences the decision or the perception that an investor has. And the bias comes into play when you're failing to appropriately adjust to new information because you're just anchored on whatever that original piece of info was. So, in this case, when you're talking about mindset, so let's use optimism and pessimism as our grounding point here. Whether one has that sunnier outlook, or tends to focus on the more negative side of the equation, you do need to recognize that that life view you have, that orientation, is going to impact your definition of success and what you bring to the table. And I think that's true in anchoring. Whether you're thinking about the objectivity you need to have to receive new information, so you don't overweight the past pieces of information. So in this case,
Sure.
it's helpful to remember with anchoring, mindset's just one factor, not the only one. It's one factor of many that will shape your decisions, your perceptions as an investor. So it doesn't determine them. I think that's really important to know. And especially when you think about what experts will define an optimist and a pessimist to be, when you think what's the difference between those two, it's not in one's level of happiness or in how they perceive that situation, but rather it's how they cope. So, how do you respond? Which is something you can work on controlling
Sure.
and improving over time. So, yes, anchoring may exist as a bias, which it absolutely does, but it doesn't necessarily mean it's going to be as strong if that is a natural tendency for you, because you and or that you can't disrupt it. So it's going to take some practice, of course, and some of that mindfulness and how you approach decision making, but it's worth working on so you can bring in the objectivity you need to let go of some of those anchors and have a healthier construct to the decision.
Sure. What's like a way that somebody could, if they're dead set on a certain investment and they can't seem to pull themselves away from getting out of it.
On keeping it as an example.
Well, maybe getting out of it. Like
Getting out
they're right. They're
So let's maybe market volatility is easier one to think about. So the pessimistic investor, let's use them as an example first. They're more likely to be anxious when trying to navigate successfully through market volatility. And that's because their framing is just more negative. So essentially, what that investor is looking for is what's going to go wrong. Will that other shoe drop? What
sure.
is it going to be? So they're going to overweight then the negative outcome and underweight the potential positive outcomes of their investments. And then on the flip side, for your optimistic investor, they're going to be focusing on things that are much more positive because they have that half full mentality and how they look at the glass. But I would caution that does not mean they should be putting on their rose-colored glasses, because it's not about walking around like that. Because it's helpful to see the positive in situations, but you must also acknowledge the negative in the situation too, or it will hinder things in the long run. So I think everyone could relate to a question like this, because it comes down to what's the riskier anchor. So double digit growth year over year for 2 years is choice one. Would you invest in
Sure.
that? Or would you invest in single digit growth year over year for 5 years? So if you put that in the context of helping someone with planning for retirement, you probably have some additional questions for them to think about when considering that investment context. What we saw in our responses is people that are wooed by the riskier option were more optimistic. in their orientation.
Okay.
And that was the one with the double digit growth, obviously, where
Yeah.
the pessimists were more conservative in the way they chose to be slower with the growth. And again, not saying either option was good or bad, but if
Yeah.
you just approach it from a mindset point of view, which was your question, you can start to see a real life investment decision where those two mindsets will fall naturally.
Sure. I mean, do you think too, like ignorance, can play a factor in this as well?
Ignorance is bliss.
Ignorance is bliss. You don't know what you don't know. And hey, double digit sounds good. You just don't know that it could be, more volatility than the other option.
Yeah, I mean, you don't want to gather so much information that it becomes analysis paralysis. It's enough
Yeah.
information that gives you confidence to make a choice, and you feel good about making that choice, and you move on. So you do want to
Sure.
have like
Yeah.
that no regrets, but get enough information that you feel knowledgeable about what you're making a choice on. What are you buying? Why are you buying it? What's its role in its portfolio, and ultimately part of the financial plan. You feel good about that choice? Great. Let's make the decision and we move forward and then just keep going.
Yeah. I mean, I've found from doing this, my clients that I'm hearing from the least usually do the best. And that's not that I don't want to hear from them. It's just
Mhm.
they must have, whatever biases minimized, right? That prevent them or have them not do the wrong thing at the wrong time, right?
Right. Well, it's interesting you bring that
Yeah.
up because the pessimist is going to likely have more worries and be more anxious, which
Yeah.
does result in more calls to their financial advisor. So
Sure.
you're 100% accurate in that. And that doesn't always mean a good thing, but again, they're taking the advice we are putting on the table, which is talk it through. I would much
Yeah.
rather hear from you with your questions, even if it's 20 deep, and make sure you're good, than not hear from you and almost give that ignorance is bliss uh, strategy a shot, because hope's not a strategy. So hoping that that's going to work
Yeah.
out, don't recommend that. Get some
For
insight.
sure. Yeah.
Get
I
some
mean,
insight.
yeah. And I mean, just more, we people doing the wrong thing at the wrong time, right?
Mhm.
Buy, buy high, sell low, which is obviously what you don't want to do. And people do that all the time. So
Correct. And
I
again,
think
that's
all
human
this,
behavior.
yeah.
Human behavior, and no one should
Yeah.
be taking 40 lashes after listening to this conversation and feel bad. It's just about proving our ability to know our natural orientation, understand a little bit more about the biases that we tend to lean into, and then how can we close our own behavior gap so we can improve decision making, the wealth management experience, and ultimately get
Sure.
better outcomes that we want and need when we think about what we need this year, what we need 5 years from now, 20, 30, 40 years from now.
Yeah. Makes sense. Awesome. Well, I think this is a good place to stop. Anything you want to mention before we wrap up?
So we touched very briefly on the concept of resilience, and I think it's a good note to end on, because when the world feels topsy turvy, which I still believe has that halo effect going on right now. We have a lot of
Sure.
uncertainty continuing, things out of our own personal control. I think if you one find the intersection between what matters and then understand what you can control, that's a happier place to ground yourself, and work on improving your biases. But resilience, when someone says, I want to be a resilient investor, just know that doesn't necessarily mean you follow a straight linear line. It means how you adapt in the face of whatever these changes are, including changing your own behavior. So I think that's good news because we all have the capability to improve our resilience. So that's why I find it so motivating and find it to be an encouraging concept, because just by practicing and getting experience making financial decisions, talking with my financial advisor, taking an opportunity to reflect back on how that went, how it felt, then I'm going to become more resilient in my investing. And I would say that's going to translate into my overall financial life as well.
Sure. When you say resilient, what do you mean? Like just dealing with adversity better?
Being able to regulate your emotions more productively is
Okay.
what that is. So how you adapt and then respond to whatever the factor or factors are that are creating the change or adversity or stress that
Sure.
you're going through. I mean, even in some cases, you could say trauma. So,
Yeah.
COVID-19 probably felt that way in the height of the pandemic, felt like trauma.
Sure. Yeah. Yeah. No, it was definitely a traumatic experience for sure.
It
A big
was.
change.
It was. It
But,
was. Yeah.
luckily a lot of us have come out of it okay. And, we're persevering, I guess, or we're resilient because of it.
Yes, you're resilient. You can learn from the setbacks, but you can also learn from the successes. And I think, again, it's the balance. So you're constantly bringing the EQ and the IQ to the decision making table, and getting enough information to be confident about what it is you're buying, the role that it plays, and what it's doing for your overall financial outcomes. I think that that's the short and sweet goal that we all have. It's easier said than done. Hard work.
Yeah, no, yeah, for sure. Yeah, it's easy in theory, but more difficult in practice, and that's where a good advisor can come in, and as well as we discussed, recognizing your biases and doing your best to manage those.
Absolutely. Yeah, patience in your decision making, I think, will go a long way.
For sure, yeah. Awesome. Well, thanks so much for coming on, Brie, and discussing this week.
My pleasure. Appreciate being asked back. Thank you.
Yeah, just as a reminder for any listener that has a question they want to have considered for a future episode, please go to retirewithryan.com to leave your listener question. Have a great week, and I look forward to talking with you next Wednesday. Take care.